Um, I'm going to talk about what's going on in the world of state and local taxes. Um, as everybody may know, that this is sort of just anything we say here is not to be relied on as tax advice. And if you have any specific questions, definitely go ahead and reach out to your tax advisors. This is for informational purposes only. So for my presentation, I'm going to talk about what's going on in the world of state taxes. I'll focus a little bit about what's been going on in Texas specifically, and then kind of speak more broadly about all the other states. As you'll find, most things in life, things will sound great at first when you hear them, and sometimes there's kind of good and bad parts of things. And so even though some things sound great, they might not be necessarily great for someone's specific facts or vice versa. So for most of us here, we're probably calling in and sitting here in Texas. And the common thought is we live in Texas, which is a great state with low taxes. And that's kind of not exactly correct. It's kind of a myth that Texas is a low tax state. Sure, we don't have personal income tax, but if you look at it from a business perspective, Texas is in the top 10 highest property tax rates in the country. And they also tax all sorts of property, including inventory. Many states out there won't include inventory in their business property, taxable property. So the more property you have, the worse kind of Texas is from a tax perspective on the business side. And even for individuals, it's a similar story with our fairly high sales tax rate that most people, the average person living in Texas is actually has one of the higher effective tax rates, compared to their salary or income than most states. So Texas is, sort of a bit of a myth. And so in the recent legislative session, which met last year, the big goal was big property tax reform. Due to things over the years, Texas had a great surplus. Part of that was, excess funds from the COVID period and higher than expected sales tax receipts. So long and short is it took a long time. It took a couple special sessions, but the legislature last year ultimately passed about $18 billion worth of property tax relief. There's not too much to talk about from a business perspective. Most of that money went towards A, increasing the homestead for homeowners, and B, effectively lowering tax rates across the board. So while that's helpful to businesses, there's not really much to say or do about that. Various things that would have been helpful to businesses were kind of brought up and discussed. Ultimately, really the only kind of small benefit to businesses is this last bullet point on this slide, which is that if you're an owner of commercial, mineral, or residential property, like a rental property, property that doesn't receive a homestead and it's valued less than $5 million, at least now there's a cap where the value can't go up by more than 20% each year over the next 3 years. Historically, there's a cap on how much your home could go up percentage-wise year to year, but no cap at all existed for business purposes. So even though this isn't the biggest thing in the world, this is kind of something better than nothing on the business side for property tax purposes. The other big thing that happened in the legislature was on the franchise tax side. And the legislature did two big things. As many of you may know, if you have revenue below a certain threshold, then you don't owe any franchise tax at all. And historically, that was about $1.23 million. That threshold was doubled to $2.47 million. So if you're a taxpayer whose total receipts are less than that amount, you do not owe any tax at all, which is great. And the second big thing the comptroller did was say, hey, if you don't owe any taxes because you have such low revenue, you don't even have to file a return. You don't have to do anything. And that also sounds like great cause for celebration. But, that's the legislature talking. And so the next step is, all right, the comptroller now has to figure out what to do with these changes. Having the no tax due threshold go up was great, but the removal of zero tax returns, again, sounds great, but what it didn't really help with is that a franchise tax report was really two parts. One is your franchise tax report, and then you filed an informational report, typically known as a public information report. And then some filers file an ownership information report. And that's essentially where you list the officers and directors of the company. And in a lot of states, you'll find that's the type of thing you file with the Secretary of State. But the way that Texas does it is it's part of your franchise tax report. So the fact that the comptroller did away with zero tax returns, they did not do away with the public information reports. So you still have an annual filing due with the comptroller, and instead of, you got rid of one piece of paper, but still something is due. Further, if you think about it from the comptroller's perspective, the absence of a return, potentially raises questions to them, right? Did you not file a return because you were under the threshold, or did you not file a return because you did something wrong and should have filed a return? So what you might, many of our clients, and maybe some of you have received a letter from the comptroller saying, hey, we received a public information report from you, but no franchise tax return. Can you please confirm, this was intentional and that you're below the threshold? So that's a bit of an annoyance that some of our clients are dealing with. And then a second kind of knockoff effect of the absence of these returns is if you want to terminate an entity, what you would historically do is get what's called a certificate of account status from the comptroller that says, hey, this entity is in good standing, they don't owe any taxes. So when they go to the Secretary of State to terminate their entity, that's necessary to get that done. Well, historically, you're able to just go online and pull that certificate of account status online from your web file account. Again, now that with the absence of these no tax due reports, the comptroller isn't allowing you to get those certificates so easily. You now have to fax something in or mail something in, and it's taking a lot longer to get those things. And so really, it sounds great that they've gotten rid of the no tax due reports, but it's actually caused a few other problems on the compliance side that really haven't made life all that much easier, at least from the practitioner standpoint. So that was about what I had to say about Texas. There's some other good news out there with some of our neighbors. Oklahoma has both an income tax and a franchise tax report. I am happy to report that Oklahoma went ahead and repealed its franchise tax report starting with 2023. So that's a little bit confusing the way that the tax years work, but essentially, if you would have filed an Oklahoma franchise tax return earlier this year, or you might have one on extension due in the fall, but that'll be the last return you're going to have to file with Oklahoma for franchise tax. It's simply being, it's just gone. So that is great news indeed. One of our other nearby neighbors, Tennessee, they also have a franchise tax. They have an income and a franchise tax. And on the franchise tax side, you kind of owed franchise tax on one of two bases. Either paid based on what they call your apportioned net worth or the value of the property that you own or lease in Tennessee. For reasons that are a bit complicated, Tennessee ultimately decided that there's a potential that the property tax base of this tax is unconstitutional. And so they removed it and eliminated the property base from the franchise tax calculation. Excuse me. So that happened a few months ago, but that legislation was retroactive. So that means if you've paid Tennessee franchise tax in the past, there's a possibility that you paid on the property tax base, and if so, you are entitled to a refund for prior periods. So there's a whole host of rules about how you go about getting that refund. And the critical thing to note is if you think you might be eligible, you got to get those refunds in by November 30th, of this year. So short version, that's good news as well. If you've been filing in Tennessee in the past, I would encourage you to just look at that return or ask your CPA to look at that return and see if, hey, did we pay any tax on the property tax base? And if so, of course, you're have an opportunity to get a refund. So those are good news indeed.
John,
good news.
Wait, John, I'm sorry to interrupt you. Just really quickly, before we move on, the franchise tax relief for the state of Texas, when does that take effect? What year is that effective for?
So that's already in place. So in other words, it was for tax returns due in 2024. So, based on your 2023 activity. So May 15th was the due date for franchise tax returns, and you would have already ideally reflected that in your actions, or your CPA would have known to, either not file a no tax due report and just file the public information report, or if you think you're in that range between about $1.5 to $2.47 million, you certainly shouldn't have had to file a return, let alone pay any taxes. So if you think maybe you fall in that bucket and you remember filing or paying any franchise tax, then I'd encourage you, again, that's something you go back and clean up or look to get that money back if that in fact already happened.
Perfect. All right. Thanks very much.
Absolutely. So just kind of talking about trends out there that I see in the state tax world and fellow practitioners. From a state perspective, the COVID years led to, frankly, a lot of surpluses in a bunch of states due to federal grants and just other things, higher sales tax revenues, just like I mentioned for Texas. That was kind of typical across the U.S. So happy to report that over the last few years, at least 80% of the states have done something to reduce their income taxes, whether that's for businesses or individuals or some combination. That has been the trend over the last few years. But unfortunately, it's fortunate that COVID is way back in the past, but now, things are kind of normalizing. And a lot of states are finding that, hey, we're in this great surplus position a couple of years ago, are turning around and realizing now they're looking at deficits in the future. So this trend has been positive in the past, positive meaning the rates have been going down, but that's likely to have come to an end, or to the extent that states are still looking to reduce taxes, they're looking to primarily do that through property taxes. So, if a state cuts their property taxes, it may have some incidental benefit for us Texans or businesses outside of that state. But obviously, those tax cuts are going to primarily benefit the residents in that state. So it's been good, but kind of looking at we're at the end of that trend and probably going the other way soon if we're not already there. Especially in some of the bigger states, you might hear of, California's got it's like $100 billion deficit or something staring at them, and they were at a surplus a couple of years ago, and things of that nature. So some of the bigger states are the ones that are dealing with these deficit issues. The trend is always in the state tax world. Now everyone's going to know my answer. Oh, I can't vote. So let me get that off my screen. So, the trend in state taxes is usually the state saying, hey, how can we get more revenue out of taxpayers? And the best kind of taxpayers are out-of-state taxpayers, the ones that don't vote. So the trend has been that states are more likely to say, hey, A, you owe a tax return here, and then B, how is that tax return based? So when you're talking about a taxpayer that's selling tangible personal property across the U.S., it's pretty straightforward. If I send $1 million of widgets to California, California is going to say I had $1 million of California receipts. The story is a bit different when you talk about a service provider. There's really kind of there's a few kind of variations on the theme, but the two extremes are you can say, hey, wherever the people are providing the service, that's where the income is generated, and that's the state that should get the revenue. But the trend in most states is to say, hey, we don't care where the service is provided, we care where the benefit is received, what's known as the market approach. So most states, the trend has been to say, hey, if you're providing a service to a customer in our state, you're earning income in our state, based on your sale to that customer. So that's kind of fine. That's kind of like a neutral statement, right? It's just one or the other. But Texas is not part of that trend. Texas takes the position that it's a Texas receipt. If you're performing a service in Texas, even if the benefit is received elsewhere, the question is, where is the service being performed? So you can easily imagine a situation where you kind of get the worst of both worlds, right? You're providing all your services in Texas to all your customers are in California. Texas will say, hey, all your income is earned in Texas because that's where you're providing the service. And California will say all your revenue is in California because that's where all the benefit is received. So that's kind of unfortunate and not great for Texas, people sitting in Texas providing those services. From a planning perspective, if you're looking to hire someone who's going to generate revenue from a service, line of income, if you're neutral, then ideally you'd want that person performing his services in a state that doesn't look at where the service is provided, but instead where the customer is, i.e. somewhere outside of Texas. So, that's something to think about. If all things else are being equal, that's sort of a planning idea you could kind of keep in mind. So that kind of addresses the service providers. Sellers of tangible personal property have another big kind of issue out there on the horizon. This is kind of some technical tax stuff. You've probably never heard of Public Law 86272. This is a federal law from the 1950s, so this is very ancient. But what it basically says is, hey, if you don't have any contact in the state except for selling stuff into that state, and really all you do in the state is try to solicit sales, then this federal law says that state is prohibited from imposing an income tax on you. So this is a great thing for taxpayers. So just picture the typical e-tailer, right? You sit in Texas, you ship your stuff across all 50 states, but you don't have any people working elsewhere. What Public Law 86272 says is you are protected and all the other states are prohibited from imposing an income tax on you if you don't have any other contacts with those states. So again, that's very taxpayer friendly, and that's been out there forever. But again, this is a federal law, so states can't, states can interpret the federal law as it applies to them, but they can't, make that law. So states have historically relied on what's known as this group, sort of a nonprofit group called the Multi-State Tax Commission. They're always doing things in the state tax world to try to make things more efficient and, common rules across states and things of that nature. But anyway, most states have always relied on their interpretation of 86272. And the MTC moved recently to update their interpretation to kind of better reflect reality, which is, unfortunately, what that means is they're basically trying to, or I interpret it, to basically take away a lot of the benefit and protections of 86272. So specifically, in just kind of looking at the internet world, if you're providing any of these unprotected activities in a state, then that state would say, hey, you're no longer protected by 86272, meaning we can impose an income tax on you. So just looking at these things, you might see a lot of things that are definitely activities you do that are unprotected. Specifically, I would look at the second item listed here, internet cookies related to non-solicitation activities. So basically, if someone comes to your website and you're sticking a cookie on their computer, and forgive me, this is not, I'm a tax guy, I'm not a technical guy, but my understanding is that's pretty much par for the course. And if you're doing that, you're at risk of blowing your 86272 protection under these new rules. Some protected activities include, if you have a static website, if all they're really doing is just using it to order stuff, you'd be okay. But, obviously in today's day and age, most websites and most companies are kind of doing a little bit more than that. So this is a very murky area, a lot of unknowns out there. As far as what the trend has been is, New York and California are two of the, obviously, the big dogs in the tax world. They've both kind of taken steps to try to adopt and these more anti-taxpayer rules, the MTC's guidance. California specifically did so a couple years ago. They adopted some new rules and regulations along those lines. But very recently, or 6 months ago, a California court actually held all those regulations to be invalid because they weren't done properly. So that was good news to hear. New York, on the other hand, they've updated some draft regulations that are going to be along the lines of the MTC. So none of this is to say anything necessarily will change tomorrow, but the line of what you can do or can't do in states is always in flux and gray, but it sounds like it's moving in the wrong direction, at least with respect to 86272. Another big thing out there in the state tax world, and I've talked about this is going back a few years now, but there was the Supreme Court Wayfair case that kind of changed the sales tax world. Historically, if you didn't have a physical presence in a state, they couldn't make you collect sales tax. And this Wayfair case, based on the website, did away with that rule. So now most states say, hey, if you have over $100,000 of sales into our state, we're going to require you to collect and remit sales tax. that is very superficially kind of the big picture, but of course, every state has a bunch of different rules about what it means to be, is it a sale? Is it a taxable sale? Is it your sales in the last 12 months, the last calendar year, the last 4 quarters? If you cross this threshold, when do you have to start collecting, the next sale, the next day, the next month, the next quarter? So all these things are done differently by the states. So this has been a years-long trend where the states have slowly all adopted rules to make it so that they collect sales tax from out-of-state, what they call remote sellers. But the devil's in the difficulties. There's a lot of challenges in trying to meet all the compliance expectations. Certain states like Colorado or Louisiana, there's actually sales taxes administered at the local level. So in theory, you'd have to register with them separately from the states. Some states will say you determine the local rates based on where you ship it to, and all these different rules. So this is an ongoing struggle. In theory, there's help on the way. States are working to streamline their rules and their compliance mechanisms, but it's been a long, slow path, and much remains to be done, and much confusion remains for taxpayers. All right. Speed up here a little bit. A couple other big things on the horizon is when it comes to digital goods, that's a big, it's the next frontier in the sales tax world. If you buy a piece of software, you buy a video game from the store, there's no question you owe sales tax. But what happens when you download that game and it's now an intangible? Most states will say they don't care, it's still taxable, but there's all sorts of different rules and different opinions on that. Take software as a service, for an example. I mean, kind of the confusion is in the name, right? Should it be taxed as a software or should it be taxed as a service? Texas specifically has its own rules where if you download software, it's fully taxable. If you do something as software as a service, they don't actually call it a sale of property. They call it a taxable data processing service, which is only taxable on 80% of the sales price. So you can see how there's all sorts of complications therein. The other big thing is states are eager to always create new sources of revenue, as I mentioned. One big thing there is with respect to digital advertising. Maryland is kind of on the frontier where they've created an entirely new tax. It's not a sales tax, it's a tax on digital advertising for the big companies, meaning over 100 million in revenue. So you might say, hey, I don't care about stuff relating to whether Google gets taxed, but of course, if they get imposed a tax, they're going to ultimately pass it through to their customers. So there's a lot of hand wringing about whether this is constitutional and it's going to work and stuff like that. So there's a lot of litigation in that area as well. Just want to note, we always say state and local taxes, usually just talk about state taxes. Local taxes are burdensome, or can be at least, as well. It's one federal government, there's one IRS, there's 50 departments of revenue, and then there's who knows how many thousands of localities, many of whom are eager to create or collect their own taxes. We talked about sales tax. Here's some examples of other things you might not realize. A lot of this stuff comes from out west. For example, in Oregon, they recently tried to create a payroll tax to fund their police, fire, and homelessness services. They already have some of these other taxes, which are very long to read, but you can see they're kind of, we raise money for X purpose, and this money will be dedicated to that purpose. So these things are kind of being created. Many cities have their own business license taxes or gross receipts taxes. So when you think about state taxes, also keep in mind, I'm the salt guy, not the tea guy, I guess. So keep that in mind. One last state topic here is, we're going to talk more about federal stuff. One of the provisions of the Tax Cuts Jobs Act back in 2017 was a limitation on taxpayers' ability to take a deduction for their state and local taxes. So they created this $10,000 cap, which you wouldn't think affects Texans so bad, but if you have investments or if you have income from other states, then you're paying state taxes as well. So what most states have done is they've kind of created what they call these pass-through entity taxes, where you can voluntarily basically elect to pay the taxes that would otherwise be due at the individual level or the shareholder level, have those taxes paid at the entity level. And essentially you'll get a credit, or somehow that'll offset what you would have owed as an individual. So that's great news. That's a great counter to this federal limitation. But as Yolanda will talk about more, many of the individual tax provisions are set to sunset in a couple of years. And so that begs the question of, well, if I do something for state purposes, can I change it if this sunsets? What does it mean after it sunsets? So just take the example where you're paying pass-through entity tax to avoid the limitation on your state tax deduction. So you go ahead, you volunteer, and you pay it, and under that state's particular rules, they impose the tax at the highest effective tax rate. And that's still worth it to you, because paying 9% instead of 8% is great, because you're saving, you're getting a 40% deduction on your federal return. But what happens when that deduction, when that doesn't matter for federal purposes? Now you're just paying more taxes, period, than you otherwise would have been. So, was that an irrevocable election? Do I have to take steps to undo what I did to, while the deduction cap was in place? So, so bigger picture, federal changes kind of trickle down to state. And here's a perfect example of one that is very significant to taxpayers. I just have one other thing to say before I'll turn it over to Yolanda, and this is a federal matter. The recent Supreme Court session, they kind of handed out a bunch of cases at the end of the month, last month. And one of the big ones was, I forget the actual case name, but its effect was to overturn the Chevron doctrine. The Chevron doctrine is now, 40 years ago? The court held that the court should defer to a federal agency's interpretation of ambiguous laws, and it allowed their agencies to create necessary rules to do so. So on the surface, a lot of businesses, a lot of taxpayers cheered for that, because that means, why do we have to defer to their opinion when ours are just as good? But when you're dealing with the IRS, sometimes you just want to know what the correct answer is, or have some guidance so you can do what they want you to do. A number of years ago, the court held that the Chevron doctrine applied to the IRS Treasury regs, and the IRS has been doing things to take those steps so that their regs are properly deferred to under the Chevron doctrine. But now that's gone, right? So that sounds great. But again, think of all the times where Congress passes something at the last second. Think about how long you had to wait for ERTC rules or PPP loan rules. And, the more uncertainty there is, that means that you might not be able, a corporation would have uncertain tax positions and they couldn't even take those amounts into their income. So, for big taxpayers, that could be an issue. And it simply just makes things more complicated. Do you want to be aggressive knowing that, there's really a total unknown out there? As one commentator put it here on the last line, that much of the day-to-day regulatory framework for tax will be put on hold and litigated. So that's not necessarily the best result at the end of the day. Sometimes certainty is better, even if it might not be the answer you want. So that's all I had. So I'm going to stop rambling now and turn it over to Yolanda. I'm going to end my slideshow and let her take over.
Thank you, John. Let me share my screen. All right. Can you guys see my screen?
Yep, that's perfect.
Awesome. All right. So I'm going to be talking about what's happening in the world of federal income tax. I know it's what everybody wants to know. Oh, skip my disclaimer. Where did it go? Same disclaimer as John. Listen, this is general tax advice. What I'm going to give you some strategies, and it might not be right for everyone, but this is something to create discussions. Go talk to your tax advisors and your financial advisors and start those conversations with them about some of the things that are brought up today. And so, don't say, oh, I heard Yolanda say this, and it might not be relevant to you. So just, don't hold me to everything. I'm just going to kind of give you a little bit of ideas here. So what I'm going to be talking about is what everybody wants to know. It's an election year. What is going to happen? What can we expect? And then we're going to take a little trip down memory lane. We're going to revisit the TCJA of 2017, the Tax Cuts and Job Act. And then after that, hello, darkness, my old friend. If you all know what that means, if you filed taxes before 2018, some of this is going to look really, really familiar to you. We're kind of going to be reverting possibly back to what it used to be. And what does that look like? What can you expect from these upcoming changes in 2026? We're gonna get into all of that. And for those that don't know, winter is coming. There are some very specific things that are going to be happening in the next few years. And now is the time that you need to prepare for those items, the Qualified Opportunity Fund, the state tax limitation, big ticket items that we really need to talk about now and address now, because it will be here before you know it. So you need to prepare yourself. And finally, how to survive in those dark times and come out shining. I'm going to give you some strategies to think about, to talk about, and to put into place if you can, to help, in some of these pending legislations. So let's talk about the elections are ahead, big tax year, right? Everybody's talking about it, both sides. One side wants to drop taxes, one side wants to raise taxes for people over certain limits. Man, if I had a crystal ball and I knew exactly what was going to happen, I would be like a billionaire. I wouldn't be sitting here right now. I'd be out like on the beach somewhere living life. So unfortunately, we don't know what's going to happen. We know what they're going to say, but we don't know what's going to happen. We can speculate, but I do want to say that, the TCJA Act of 2017 was a huge tax bill that we hadn't seen tax changes in a while. So before that, President George Bush in 2010 issued his own tax bill, and that was the last time we really saw any major tax, changes. And before that was Reaganomics, if you remember those days, and that was in, I think it was the 80s where that happened. So it's been a second. Like, it takes a while for changes to happen in the tax world. Everybody talks about it. Everybody wants changes, but it's hard to make it happen because one, you have to have bipartisan agreement. Both, everybody has to agree to pass a bill, and it's hard. It's hard to get everybody to say, yeah, I want that. So I know the most recent chitter chatter and the most recent bill that's being talked about right now that we were hoping would pass earlier this year had to do with bonus depreciation and the way R&D credits are calculated. So there's a bill that did get bipartisan agreement in the House, and then it moved on to the Senate, and that is where it is sitting currently. It is in the Senate, and there's talk that they're going to be bringing it back up in the fall and addressing it, and maybe they'll pass that bill, but the likelihood that it gets passed is kind of getting less and less the longer that, it sits there in the Senate. But basically, they were talking about taking that bonus depreciation back to 100%, which was, what was it? It was like that in 2018, 2019, 2020. The R&D credits just recently in 2022, the way we calculate them changed. It used to be that if you had research and development expenses, you were able to deduct those and you can get a credit for it. Obviously, you can't double dip. So you had to reduce the expenses by the amount of the credit. Not that big of a deal. Now the rule is all the expenses that are related to the research and development are having to be capitalized over 5 years. If they're domestic, 15 if they're foreign. And so, that's causing higher income for businesses. You get the credit, but you are now going to pay more taxes because you are not allowed to expense all of those deductions right away. So we were hoping that it would revert back to the old ways, and that would be a great thing. So those companies that did decide to capitalize their expenses because they had them and they got the credit last year, we were hoping they were like, yeah, this year we're going to be able to take those expenses that you capitalized. This year it's going to be great. We don't know. We don't know what's happening. So like I said, it's up in the air. I'll be sitting there waiting with everybody else. Like, I'll find out when you guys find out what's going to happen. And then at that time, you know, then we can definitely have another webinar and discuss, hey, these changes are happening. So that's what we know. So we're going to go back, way back, right? Memory lane, TCJA. What was enacted in the TCJA? So the Tax Cuts and Job Act of 2017, effective in 2018, brought about a flat 21% federal tax rate for C corporations. That is a permanent law, so that is not going to change unless they make another law and change it. But that is going to keep on going. So that's a great thing that makes us more competitive with other countries that have lower business rates in their countries. To be fair to those business owners that are not C corporations, like the pass-through ownership, partnerships as corporations, and the sole proprietorships, the Section 199A deduction, qualified business income deduction, was created. That's a 20% basically haircut on your qualified business income. Now, there are some rules around it. If you're considered a specified service trade or business, those are your accountants, your attorneys, people that do consulting. They have some other things that they have to do, like wages and, you know, the basis of their assets. They have to do a special little calculation. And if their income hits a certain level, then that QBI is kind of phased out. But for regular people or regular businesses that aren't those specified trade or service trade or business, they do get that 20%, which was a great deal. And we'll talk about that in a little bit. They did eliminate the corporate AMT, alternative minimum tax, which was great. For individuals, they didn't eliminate it, but they made it harder to fall into. So basically, the limitations for the AMT were pre-TCJA were about 84,500 to about 161,000. So if you fell within that range, you didn't have to worry about AMT, right? If you were above 161,000, well, then your income, the difference between your taxable income and your deductions and your alternative income would be taxed at like 26 or 28%. So the TCJA, they changed that from 126,000-ish to about $1.2 million. So that exemption rate was a lot wider and covered a lot more taxpayers. So less people were in AMT, which for a tax accountant is lovely because then we didn't have to do all those extra calculations. But that is one of the sunsetting things. I don't have it on my list, but the AMT for individuals is coming back. So it's something to think about. They had stricter rules on deducting net operating losses. They lowered income tax brackets, which was amazing. They increased the standard deduction, at the same time eliminated personal exemptions. They did what John just talked about. They put a $10,000 cap on state and local income tax deductions. Everybody was up in arms about that. We'll get into that too. They increased the child tax credit, the mortgage interest deduction. They lowered the amount of debt that you had relating to what you can take for the mortgage interest. They increased the Section 179 depreciation deduction limitation. They created qualified opportunity zone investments, amazing tool. We'll talk about that. And then they also increased the state and gift tax limit to $11.58 million in 2018. So there was very much business friendly. A lot of great things came out of this. Now we're going to talk about what's going away. Sunsetting tax laws. So some of these laws these laws were set to go away December 31st, 2025. That means the 2026 tax year, you're going to be seeing a lot of this stuff come back. So lower individual income tax rates. Income tax rates, if nothing changes, whoever gets into office, if they don't extend this act, then we are going to be looking at the same pretty much tax rates as we did pre-TCJA in 2017, which means right now our highest tax bracket is 37% as of today, 2023, right? So for a married filing joint, that is Once you start making 693,000 around there, you are in the top tax bracket. So the top tax, so that 37% is going to go up to 39.6% in 2026, should nothing else change. And the top tier, like the money that gets you there, the income that gets you there is only $470,000 if you're married filing joint. Big difference. So there's going to be an increase in tax just from this jump in tax bracket. So that's something to look into and keep an eye out for. TCJA, they increased the standard deduction. Well, we are now going to go back to what it was. We're going to cut it in half. So currently the standard deduction is like $27,000. It's going to drop down significantly. Well, by half. It should be like 30,000, but they do adjust it for inflation. So I believe the estimated 2026 standard deduction is about $16,000 for a married filing joint couple. Let's see, the mortgage interest deduction debt limitation, they had dropped it. TCJA dropped it to $750,000. It is going back up to $1 million, which is great. So if you have debt on your house that you own and you had $800,000, $900,000 mortgage on it, you will now be able to take that full mortgage interest deduction in 2026. Whereas in 2023, it could have been limited depending on when you bought your house and when you got that debt. They eliminated miscellaneous itemized deductions with the TCJA. Those are coming back. Now that the standard deduction is going back down to what it used to be, they're bringing back these miscellaneous itemized deduction. You're like, well, what is that? What is it? What is the miscellaneous itemized deduction? Those are your investment advisor fees. Those are your accountant fees, which you pay your accountant, or your unreimbursed employee expenses, like your home offices. A lot of people were upset because they were W-2 employees and they worked from home. With COVID, a lot of people worked from home. And that law right there just eliminated their ability to deduct their home office. So now all those people that are working from home, you will now be able to deduct your home office expenses. So keep track of those expenses and those receipts, and your accountant's going to be asking for it come 2026 should any of this not revert back. They eliminated personal exemptions with the TCJA. They are now coming back. There are some rules about personal exemptions, but for the most part, because the standard deduction is going back down, the personal exemptions are coming back up. They increased the child tax credit. That is going back down. It was $2,000. I think it's going back down to $1,000 a kid. And the biggest thing for business owners, the Section 199A QBI deduction is going to go away. So while the corporate income tax rate is going to stay at 21%, that nice little 20% discount for everybody else is going to go away. It's not going to be, equal footing anymore. And I know what you want to know. I have been asked this 50 million times. Well, does that mean I should be a C Corp? I'm a partnership. I'm an S Corp. I'm a sole proprietor. Should I be a C Corp? You need to talk to your tax accountant, because there are some great things about being a C Corp. And yes, that 21% is one of them. But at the same time, there's double taxation. There's different rules that you need to know. And switching over from one type of entity to another could bring some, consequences that you're not expecting. So have that conversation with your accountant. Ask them, is this the right situation for me? And at least start that conversation. And bonus depreciation, everybody's friend. It's been everybody's friend for a long time. It was 100% for, it seems like many years. It currently in 2023 got reduced to 80%, and it's going to keep dropping 20% every year until it phases out in 2027. So hopefully they bring that back, but there are other depreciation things like Section 179 that is still there. So, we're going to be talking about that too, how to maximize your deductions, but those are some of the key provisions that are going to be going away in the future. So what does this look like? Okay, so now accountants, Don't come for me. This is like very general. I understand there's a lot of nuances to taxes. And so I'm being very like general here. So kind of hang in there with me. So we have John and Jane Doe. They own ABC Company. ABC Company makes and sells widgets. They have annual revenue of about $2 million, net business income of $800,000. They filed married filing joint. What do their taxes look like now in 2023? And what would they look like in 2026 if they're in the same situation? So if they were to take the standard deduction, so their adjusted gross income is $800,000, okay? They qualify for the QBI deduction. They get that 20% haircut. That's $160,000. Beautiful. Standard deduction in 2023, $27,700. That means their taxable income is $612,000, okay? Now, they're about in the 35% tax bracket. And so to just do simple math, I know we have graduated tax rates. So if you guys don't know how tax works, it's graduated. Every dollar is taxed at a different amount, depending on where you fall in the bracket. I just did 35 just to be simple. They're going to owe about $214,000 in taxes, okay? Now, fast forward, 2026, same situation. Adjusted gross income, $800,000. There's no QBI deduction. They don't get that. Personal exemptions, they're back. They're $5,300 a person. Well, why is that a zero? It's because personal exemptions go away based on your limit. They fade away. I think it's like in 2017, it was about $315,000 for a married couple. Once you hit that threshold, you were no longer eligible for those personal exemptions. So somebody making $800,000, the likelihood that they're going to get personal exemptions is pretty slim. So they're not going to get those exemptions. Standard deduction is estimated for 2026 to be about $16,600 due to inflation. So their taxable income, $783,400. They are in that top tax bracket. Remember that 37% or 39.6% started at $470,000. They're in that top bracket. So they're estimated to pay $310,000 in taxes, almost $100,000 more from 2023 to 2026. Now, I know we said this, standard deduction is changing. Yolanda, more people are going to itemize. I got you. Here we go. Let's talk about itemizing. What does that look like? So very simple Schedule A. We have medical expenses. Very few people qualify for medical deductions because it's 7.5% of your AGI, over 7.5 of your AGI. So for an $800,000 taxpayer, that's $60,000. These people had $6,000 of medical expenses. They're not going to get that deduction. Most people don't. Usually when you get to retirement age, you start kind of, your income drops, medical expenses go up. That's when you kind of see that deduction come into play. Taxes, $50,000 in taxes, regardless of property, where you live in Texas, let's say those are property taxes. It's capped at $10,000 in 2023. That's all they got. Mortgage interest, we're just going to assume that they are not limited. Their debt was fine. $36,000. Charity, the way charity works is you can contribute up to, or you can get a deduction for up to 60% of your adjusted gross income. So they could have contributed $480,000 and gotten a deduction. They only did 100, so that's fine. And miscellaneous deductions, they are non-existent in 2023, so they did not get that deduction. So in 2023 standards, they would have got a standard deduction of $146,000. Now, going to the future, still don't get that medical. They get their full taxes. That's beautiful. They get the full $50,000. Woohoo, yay. I know a lot of taxpayers are going to be happy about that. Mortgage interest is, they're getting it all. Charity is the same, getting it all. Here's the miscellaneous deduction. They had $20,000 in miscellaneous deductions. They're getting $4,000 of that. Why? So they're limited 2% of AGI. Well, 2% of 800,000, 16,000. So they get what's over that, which is $4,000. So there's that deduction. So their total Schedule A before limitation is 190,000. Yeah, I said limitation. Did you catch that? So there is a limitation. We had this limitation back in 2017. It is back. It is based on income. So there's a calculation that gets done, but essentially If you make over a certain amount of 314,000, I don't know what it's going to be in 2026 because of inflation. Your Schedule A deductions are going to be limited. So after the limitation, their Schedule A deductions would be 175,000 roughly. So at the end of the day, in 2023, after itemizing, they would have had 172,000, and in 2026, 250,000. So there's still a significant difference between taxes now versus what is coming down the road. So here's the comparison of where we are in 2023. You can tell taxes are down significantly compared to what we're doing in the future. Now I know, and I hear it, I can see the people thinking, well, $800,000 AGI, that is just not typical. That isn't, they said they're going to raise taxes on everybody over 400,000. So what about somebody under that? Okay, let's look at that. $350,000, QBI deduction, 70 grand. Standard deduction, 27.7, taxable income, 252, estimated taxes in the 24% tax bracket, about 61,000. Again, same things, 350,000 AGI in 2026. They do qualify for the personal exemptions. Woohoo, they're low enough, 10,600. Standard deduction, 16.6, taxable income, 322. Estimated taxes due, now they're in the 33% tax bracket. It's only about $107,000. $45-ish thousand still is an increase in taxes. So taxes are going up. That's something that we do know. How are we going to handle that? How are we going to strategize about that? Before we get to that, we're going to talk about the winter is coming. Qualified Opportunity Fund investments
Yolanda,
is, yes.
I'm sorry to interrupt you. Just really quickly before you dig into this topic, we're about 3 or 4 minutes out on the top of the hour.
Yeah, and there's so much to talk about. Okay, well, let me just talk about this real quick. So Qualified Opportunity Fund was this great thing, and it was put into place to kind of help taxpayers invest money into low income or distressed areas. Now, what's great about this is that taxpayers can take their gains and they can invest it into a qualified opportunity fund. That those taxes are deferred until December 31st, 2025. So in 2026, they're going to have to pay these taxes, right? If you held that for, if you started investing in 2018, in 2026, you have it over, if you've held it for over 5 years, you get a 10% reduction on that gain you're going to realize in 2026. If you held it for over 7 years, you're going to have a 15% reduction on that deferred gain that you're going to have to pay in 2026. Now, if you continue to hold that investment for over 10 years, any appreciation on that investment will be tax-free. So you will pay taxes in 2026, but if you continue to hold that investment, when you sell it in, let's say, 10 years plus 1 day, whatever money you made on that, you'll get a step-up in basis, which doesn't really happen unless you're like dead. And, you know, that's usually when you get a step-up in basis. You'll get a step-up in basis and you will pay no tax on that sale. Now, there's a lot of intricacies. There's a lot of talk going around because the government really likes this program that they're going to extend that deadline from 2026 to 2028. So just keep an eye out for that. But if they don't extend it, this is going to hit, and this is going to hit, and you need to make sure you're in the right place for this. You need to make sure that you are either talking to your investment advisors and harvesting losses. You are looking at other ways of creating deductions, such as you sold your business, which created the gain. Well, you need an active trader business, such as, let's say, rental real estate. And so you can be an active real estate professional and take accelerated depreciation on those rentals and have those losses offset some of this gain when it comes into play. So there's different things you can do to reduce this, but you know it's coming. So plan for it. Talk to people and make sure that you are staying on top of this. Finally, the state tax limitation is going to be dropping by half. So it's like close to 14 million. It's about to drop down to $7 million. Now is the time to have these conversations. This is going away December 31st, 2025. As of 1/1/2026, this will be half. So there are tools, there are trusts, there are gifting strategies that you can do now to maximize your exemption. The government has already said there is no clawback on this. So if you've used up your 14.8 in 28,000, I think it's for a married couple. If you use up your exemption now and it drops down to $7 million, they can't take that back from you. So you need to start making these conversations now with your state attorneys and getting trust in place or getting different plans in place now, today, because if you wait till next year, those estate attorneys are going to be really busy and it just might be a little bit too late for you. So have those conversations now. And there's so many other strategies for, tax planning for the future. What can I do? First things, look at your finances, look at your business as a whole, get your finance, make sure your record keeping is great, because that's going to not only save you in the long run and you're going to know where your business is at, but it's also going to save you on tax preparations because it's going to make the preparation of your taxes easier. Taxes are going to be higher in the future, right? Taxes are low now. You want to accelerate income now and defer expenses later. And then Roth conversions. If you don't know what a Roth conversions is, talk to your tax CPA, talk to your financial advisor. That is a great tool to use to look at taxes now versus later. You're going to pay up front in lower tax rates and then take it out later, potentially when the tax rates are higher. It'll be tax-free in the future. So many other things and not enough time.
Yolanda, John, thanks a bunch for your time today. It was invaluable. We really appreciate it. Thanks, everybody. Have a great afternoon.